We know that we've been talking about inflation index bonds for a while on this show. You remember we had a discussion in July. We talked about how linking it to the WPI was not the most effective way to really beat inflation. The RBI has now sent out a circular talking about a new version of these inflation bonds. Take a look at the changes and how it will help you beat inflation when they do come in.
As investors, we have very few investments to hedge against inflation. Traditionally, we end up using gold and real estate to ensure that our investments are not eroded by inflation. Well, there is good news for all the savers out there. RBI plans to launch the much-awaited CPI index bonds in December. Let's take a look at some of the features of these bonds. The biggest advantage that these bonds offer is that they will be more effective at beating inflation than the WPI index bonds, which were announced earlier in May. Experts consider CPI as a better indicator of real inflation that affects you and me. The bonds have two components of interest. One linked to the movement of consumer price inflation, which will be calculated with a 3-month lag, and the other is the real rate of 1.5%. The interest will be compounded on a half-yearly basis. Simply put, one part of your interest will be variable based on the inflation rates and the other fixed at 1.5% annually. Here is an example of how the bonds work. Suppose you invested 10,000 rupees in December 2013. The first coupon payment is 6 months later, in June 2014. To calculate the inflation index which will be used will be of 3 months earlier, so March 2014. The average inflation for 2012 stands at 9.30%. Let us use that as the inflation rate. So the interest paid out will be inflation at 9.30% plus the real rate of 0.75%, which equals to 10.05%. The interest rate will be calculated using the inflation number 3 months prior. Suppose the inflation rate remains constant at 9.30%. So the interest paid out will be inflation at 9.30% plus the real rate 0.75%, which equals to 10.05%. We can see here that in the last 1 year, you have got an effective return of 12,111 rupees on the 10,000 rupees invested, which is 21.11%. The interest on these bonds, unlike the ones announced in May, is cumulative. That means there will be no interest paid out. Interest will be paid along with principal only on maturity. The bonds will be issued for a tenure of 10 years. The investor will be allowed early redemption after 1 year in case of senior citizens and 3 years for others. Experts are recommending these bonds to investors who do not need the cash flow in the next few years. The bonds can be a small part of a long-term portfolio, helping you protect your investments from inflation.